Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's video, we're going to revisit one of my favorite subjects and one that I still think does not get enough press or airtime, and that is Canada's productivity emergency. We'll discuss what it is, what has happened and why, and we'll finish with why we as investment managers are paying close attention to productivity growth and how ignoring this emergency can negatively impact our clients. So let's get started with the phrase productivity emergency. Where does it come from? Well, it comes from a speech Carolyn Rogers, Senior Deputy Governor of the Bank of Canada, gave in March of 2024. For the uninitiated, part of a central banker's role is to go around the country collecting intelligence, meeting with business and community leaders, and providing insight on all the great data and research projects done at the Bank of Canada. Officials also give speeches, which are, given the importance of a central banker's role, quite measured in their language. The words they choose matter as these individuals can and do move the markets. That's why, in my view, the speech Carolyn Rogers gave in March of last year is so important, the title of which was Time to Break the Glass, Fixing Canada's Productivity Problem. For her to use such pointed language and stress the urgency of her message highlights the magnitude of the situation Canada finds itself in. It is an emergency. Please pay attention. And in the speech, she laid out the factors that determine what makes an economy productive, e.g. capital intensity and labor composition, and then she raised the alarm on how Canada has fallen so far behind. Before we get into the update from Bank of Canada and discuss what's gone wrong and how we can fix it, we have to define productivity. Productivity is a way to measure how efficiently inputs, such as labor and capital, are used to produce a good or a service. There are several measures of productivity, but labor productivity is the most common. This measure is calculated by dividing the value of goods or services produced by the amount of labor required to produce them. Yes, productivity measures are flawed. This is because primarily they capture easily quantifiable data like GDP or hours worked while ignoring unpriced, hard-to-measure contributions like unpaid work, childcare, environmental damage, quality improvements, and the value of leisure. Ignoring these extras can lead to distorted pictures of human progress. Nevertheless, productivity, the way we calculate it, is the most common and most useful and most relied upon. However, I would warn Canadians of those who have begun to dismiss these blunt measures. This newfound commitment to economic rigor is entirely political. It's cover for policy choices that have directly led to Canada's abysmal record on GDP per capita. No one questioned this methodology until the numbers became politically inconvenient. So why is productivity growth important? Well, it is essential for several key reasons, but in particular, it improves living standards. It does so because it is one of the primary drivers of long-term economic growth. When workers, businesses, or the economy become more productive, they can produce more output, goods and services, without increasing the input, such as labor or capital. This leads to higher GDP and, over time, economic expansion. As people become more productive, their incomes rise, improving their purchasing power, and their overall standard of living rises with it. And that's what we see in this chart from the most recent BOC speech on productivity. For Canadians suffering a cost of living crisis, productivity also keeps prices low as goods and services can be produced more efficiently. And don't take my word for it. That's literally what Nicholas Vincent of the Bank of Canada said in a speech just a couple of weeks ago. Canada's affordability problem is really a productivity problem. To make things more affordable, we need to raise our income, and the way to grow our income is by increasing productivity. As with most things economics, it's a confluence of factors, and they tend to be interrelated. So where are we? How did we get here? And what's going to fix this problem? Well, at its core, Canada is dealing with the issue of perception versus reality. Headline growth figures for Canada over the last few years have actually been pretty good. And that's the blue line you can see at the top of the chart. And make no mistake about it, some clearly have benefited from that growth. Corporate and tax revenues are up, housing's up, rents are up. There has been more aggregate demand, full stop. But if that was the only thing that mattered, then why is the BOC again raising the alarm about productivity growth? And the truth is that headline GDP growth number is, in a way, fake. It was outsized population growth that lifted the headline number, whereas in reality, Canada's per capita GDP has been flat for nearly a decade. There has been no sustained productivity growth in the economy, and productivity is the key to lifting the overall well-being or the standard of living of everyday people. To really hammer this point home is the following chart. This is the 10-year compound annual growth rate of GDP, and two factors that make it up, population growth and productivity growth. And as you can clearly see, there has been a shift in the driver of that headline GDP growth figure in blue. This chart again highlights why Canada has so far avoided a technical recession, or 2 quarters of negative GDP growth. And that's because of the very strong population growth. The totality of economic output is the number of people multiplied by each individual's output, or productivity. An economy can grow even when productivity is negative if the population growth jumps up to replace it. And that's exactly what we've seen over the last few years. So what happened to population growth, and where did these people come from? The following chart is frankly just incredible. It shows just how dramatic population growth in Canada has changed over the last few years. From 1980 to 2015, population growth averaged 320,000 people per year. Over the last 3 years, this number has more than tripled to 971,000 people. Where did these people come from? According to the Bank of Canada, nearly 100% of Canada's population growth from 2015 to 2025 is driven by immigration, including both permanent residents and non-permanent residents, as natural increases, births minus deaths, have been negligible or negative during this period. The problem with the huge influx of people is twofold: the number and the composition. First, the number. And as an example, from January of 2023 to January of 2025, there were roughly 2 million new entrants to Canada, but private sector jobs for only about 500,000 of those people. That's clearly an insane way to run an economy, and indeed, they eventually changed the policy when it became politically expedient to do so. From an economic perspective, a person in work is clearly more productive than a person who's not working. And we can see what happened to the employment ratio, the number of working people divided by the total number of people. It fell to almost a 20-year ex-COVID low. Even the employment ratio for prime age workers, aged 24 to 54, fell, leading to the biggest ever decline outside a recession by a factor of 3. The other problem is the composition of newcomers, and people will get sensitive about this and maybe even offended. But there has been a change in that composition, and it would be intellectually dishonest to ignore it. In May of this year, the Bank of Canada published a paper called The Shift in Canadian Immigration Composition and Its Effect on Wages. And one of their conclusions was, and I quote, "If newcomers' conditional wages reflect their labor productivity, the productive capacity of the Canadian economy grew less than it would if recent newcomers had the same socioeconomic characteristics as in the past." End quote. The immigration jump was not only meaningful because of its size, but also because it was driven by the people who were significantly younger and less experienced, i.e. less productive, than in the past. And to quote the BOC again, this gain has been particularly acute for certain industries such as accommodation, food services, and building and other support services and retail trade. Labor productivity in these industries, which are comprised of sizable share of low-skilled occupations, is lower than the average business sector. End quote. So now I think it's fair to conclude that mass immigration has most definitely negatively affected Canada's productivity. But of course, it is absolutely not the only reason that Canada is suffering from a productivity emergency. Another, although admittedly not the most important reason, is the growth in public sector employment. This is because government jobs typically exhibit much slower or negative productivity growth compared to the private sector jobs. And shifting a larger share of the workforce into the private sector mathematically drags down the economy-wide average productivity growth rate. As you can see from the chart, public sector work has significantly outpaced the private sector employment growth of the last 10 years, and this in part helps explain the decline in productivity growth. Now, of course, no one is saying that public sector employment is not important. It provides essential services, infrastructure, regulation, and supports the daily well-being and enables the private sector of all citizens in Canada for us to thrive and survive. But in Canada, it has gone way too far. Public sector made up 40% of the growth of total employment over the last 6 years and now sits at a 30-year ex-COVID high, at the same time as public sector productivity continues to languish. Indeed, we saw in the latest budget, they've actively targeted this for some kind of change or recalibration. Clearly, it's understood that they've gone too far, and in order to improve productivity, they've changed course. But it's not just public sector employment. This week, productivity growth coincides with the largest government economic footprint in a generation, and again, there's little to show for it but pain. This brings us to the biggest reason why Canada's productivity has been so poor, and it's the lack of investment, or CAPEX. This chart is the share of spending on machinery and equipment by businesses in Canada, the US, and Europe. And it's here where Mr. Vincent of the BOC makes the point that it's become a vicious circle. Businesses in Canada have been investing too little for too long, but Canada's weak productivity itself is one of the factors that reduces investment. Weak productivity growth weighs on wages that businesses pay and their workers, and the slower wages rise, and the more fragile consumption becomes, and with it, household demand for the company's products shrinks, and around the drain we circle. In a world with loads of regulations and high taxes, businesses are loath to invest their money. And yes, again, immigration plays a part here too. Research cited by the Bank of Canada suggests that firms in areas with high growth in labor supply due to immigration invested less in machinery per unit of output. This implies that people were hiring cheaper workers instead of investing in machinery. We see that in the following chart as capital shallowing, shrinking per capita investment per worker. However, Ms. Rogers makes it clear that although weak investment has been a problem in Canada for a long time, with there being a persistent gap in the level of capital spending per worker in Canada versus the United States, the situation has become worse roughly over the last decade. While U.S. spending on investment per person continues to increase, Canada's investment levels are lower than they were a decade ago. So based on a per capita GDP growth over the last decade, how does Canada stack up? Horrible. Canada's 37th out of 38 countries in the OECD, which is clearly not good, and why the Bank of Canada continues to drone on about this. It's also worth noting that for Canada, this horrible performance is actually relatively new. Between 1994 and 2015, Canada's per capita GDP growth grew lockstep with that of the US. The levels may have been a little bit different, but the growth year on year through different cycles and recessions actually kept up with America. So apart from being a patriotic Canadian who wants to see the standard of living of working people rise, why do we as investors care about productivity? Well, the answer is 2 reasons, maybe 3 reasons, but it's inflation, bond yields, and the currency. To reiterate what Vincent said, Canada's affordability problem is really a productivity problem. We want to make things more affordable, we need to raise our income, and the way we grow our income is by increasing productivity. On top of improving the standard of living over long term, strong productivity also makes us more resilient to shocks and headwinds. The direction of inflation also has meaningful impacts on interest rates, both at the long end of the curve and on the short end, or what the BOC decides to do with its overnight target rate. Inflation and interest rates in turn affect the Canadian dollar. And all things being equal, if an economy is less productive, money will flow out, which puts pressure on the currency. And a weaker currency will lift inflation, again, all things being equal, and make things less affordable, which is something that our clients on fixed income have to deal with. At the end of the day, when a central banker tells you there is a productivity emergency, we should all stand up and take note, especially because this was happening before the trade war happening. It's also Canada's biggest opportunity. Our recent record is so poor, there's nowhere to go but up. I would also suggest that solving Canada's productivity emergency, although will take a long time, is a rare thing. It's a panacea, as improving it can and will solve so many of Canada's problems. Inflation, high debts, healthcare outcomes, the vulnerability to volatile trading partners, and yes, it will increase the standard of living of Canada's working class Canadians from coast to coast. All right, that's a wrap on this week's episode. Please like, subscribe, and follow for more. Please share this video with some friends and some family. It's one of the most important things I've done in recent weeks. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.